Stop listening to the headlines about the Magnificent Seven. The real story isn't just revenue or earning per shares, it's valuation. After reading all the reports, my analysis reveals which of these giants are still worth buying and which are dangerous value traps. Stick around to see my valuations. We started a couple of weeks ago with Google and Tesla, and we continued last week with Microsoft, Meta, Amazon and Apple. And right now only NVDA is missing, like always the most desired guest, it's late to the party. So, my question for you, can you guess what's the best deal? Which one is the most undervalued and which one is the most overvalued at the current price? Make your guess now, stop the video, write a comment. To be honest, I was surprised myself by the results. The answer is probably not what you are thinking. Like always, not financial advice, just YouTube entertainment. To value the Mag 7, we will use my own framework, the value ratio. I will show you exactly step by step how it works and the assumptions behind my results. I'm happy if you disagree with my inputs and you should try with your own different numbers. The beauty of valuation is that it's personal and it's something between a science and art. Basically, you have to take the story of a company and translate it into numbers. So let's start, let's jump in. Here we have the 7 companies. First, let's look at the real price tag of these giants. So forget the market cap. When I value a company, I always include debt as well, using what I call investor price. If you want details, you can watch this video, but basically is the real price of the company. Luckily, the Mag 7 mostly have very little debt, so as you can see, their investor price isn't dramatically different from the market cap, unlike some heavy debt companies out there. GM come to my mind. These are magnificent for a reason, so here is the current investor price for each one. Congratulations for Microsoft for taking back its first spot, well deserved in my opinion. Next, I want to see owners' earning potential. I calculate this by using the sales of the last 12 months multiplied by the owners' earning margin. Basically, we want to see how much owners' potential we get as shareholders. Here are the numbers. Behind these values, there is a margin assumptions for real earnings that we can get as owners. For example, if free cash flow is very high, but much of it comes from share-based compensation, Google, it's not valid from this calculation. As you can see, the price of any company is directly related to this earnings potential. Microsoft is the most expensive and also the higher earnings. Same goes for Apple at the second spot. There is a direct correlation. People want to make money, therefore they pay more for companies that are money-making machines. If we take the ratio between the investor price and the owner's earnings potential, we get something similar to the price-to-earning ratio, with Google reading around 21 and Tesla last with almost 100. Now, Tesla is extreme. Sometimes I actually think Berkshire should be the 7th magnificent instead. If you know PE ratio, you know that these numbers don't really tell the whole story. Companies with extremely high ratios, like NVDA, can be better deals than companies with very low ones. Why? Because growth and risk also influence value. Let's start with growth. We need to forecast how earnings will grow or decline in the future and calculate what earnings might be after a certain number of years. Personally, I like 5 years. It's not so far that it becomes impossible to forecast, but not so close that growth doesn't really matter. Of course, the further you go into the future, the more growth becomes relevant for our valuation results. So let's say we project a 50% compounded growth for the next 20 years. Then any company today will look cheap because the growth would be so much that the price today would not really be relevant anymore. I would argue it's actually impossible to forecast 20 years ahead accurately. Anyway, these are my 5 years growth rate assumptions, with Apple growing 5% only and NVIDIA and Tesla at 20%. So, 5 years from now, earnings could become this. Microsoft dominates again, followed by NVDA closing the gap thanks to the faster growth. Tesla earnings are still way lower than the rest. But now we can compare the investor price to the earnings 5 years from now, presenting a very different picture. We can see that, more or less, they are all somewhat aligned between 13 and 18, proving that the market is actually quite rational when pricing huge gaps. However, Apple with little growth seems more expensive, and of course Tesla at 38 keeps looking very overvalued. But wait a second, let's not jump to conclusions, we need to add risks, the negative side. Without detailing exactly how and why I assigned this course, they include every possible risks. Share dilution, competition, moat strength, cybersecurity, management skill, and so on. I believe Microsoft is the safest company now, just 5 risk score, while Tesla is the riskiest. These scores can go up to 100, so are all actually quite safe. They are the Magnificent 7 after all. Including the risks into the equation, we finally arrived to my personal metric, the value ratio. This method is new, is experimental, but these are the results. The best deal currently is Meta, followed very closely by the only Mag 7 I own in my portfolio, Google. Believe it or not, these numbers are not high. Compared to the rest of the market, the current median value ratio is around 26-27. They're actually quite cheap, but maybe you think every company in the current market is so expensive that they look cheap compared to them. Well, it's possible. In that case, it's best to compare those numbers to the 10-year Treasury yield, currently around 4.3%. At 4.3, you would double your capital in roughly 16.5 years. Well, even compared to this benchmark, Google and Meta looks like better deals. First, because their value ratio is under 16.5. Second, because we projected growth for only 5 years. Third, because in 16 years you will have your money back via owner's earnings, and these companies will likely value more than today. The clearly overvalued one appears to be Tesla at almost 60. Of course, you can disagree with my assumptions. Maybe you think Optimus will crash it and the company will grow at 60% annually. Suddenly, it becomes cheap with a value ratio of 14. Don't take anything for granted. It's important to use your own mind and your own numbers. By the way, Microsoft is also a very compelling deal at 18, according to this framework. Let me know if you like this kind of valuation comparison as much as I do. Let me know if you guessed that the cheapest was Meta or if you thought Google like I did. That's all for today. Thank you very much for watching the video. Please subscribe. See you next week. Peace out.